Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. My name is Sava, and today we're going to discuss portfolio performance evaluation techniques, some of the simplest measures and tools you can use to determine whether your investment or your portfolio performed well or not so well, adjusted for various types of risk. Why is it important? Well, we already know that most investors, or roughly all investors, are risk-averse. They definitely want to obtain higher returns, they want to make more money out of their investment, but they are potentially willing to sacrifice some of the reward potential, some of the upside, for a smaller downside, for smaller amounts of risk that they would have to take in order to allocate their capital. And this can be illustrated perhaps the best by a simple case. Consider two investors. The first, let's call her Alice, invested at the end of 2007 $100 into an exchange-traded fund called Artisan Global Opportunities. That is a global equity market tracker fund. It means that Artisan Global Opportunities tries to mimic with their portfolio the dynamics of global stock market. While the second investor, let's call him Bob, invested $100, again at the end of 2007, into Barings Fixed Income Fund, which is a bond fund. It combines corporate and sovereign bonds into its portfolio. And if we see graphically how the two portfolios of Alice and Bob performed throughout the years until the end of 2019, we will see a picture that is quite telling. First of all, Alice made much more money over the course of these 12 years. Having invested just $100, Alice is currently sitting on something negligibly smaller than $300. If we look at the exact number, it's $297.03. So her capital almost tripled over the course of 12 years, which is not bad. So she's undeniably a lot richer now, while Bob's capital is currently at $168.79, so multiplied by just a factor of 1.7 over 12 years. From just that, can we say that Alice is much better investor than Bob is, or at least Alice has been more successful? Not really. If you look even at the graphs, at equity curves of these two portfolios' performances, you can see that Alice's portfolio, which is a global equity market fund tracker, has a more volatile performance characteristic. Overall, you have lower lows, higher highs, some significant dips, particularly attributable to the 2007-2008 financial crisis, while Bob's equity curve, Bob's portfolio performance, that is composed of corporate bonds and sovereign bonds, is much smoother. It still has an upward trend, albeit to less of an extent than Alice's portfolio. But in exchange for that, Bob secured much lower volatility of his portfolio. So how to compare the performance, the returns, to get at least some insight into which of our investors, Alice or Bob, has been more successful in risk-adjusted terms, we need to resort to risk-adjusted performance measurement tools, which are the simplest portfolio evaluation techniques. To calculate the three simplest risk-adjusted performance measurement tools that are Sharpe ratio, Treynor ratio, and Jensen's Alpha, what we need to do is we need to consider a benchmark, which is most of the time a valid representation of the general stock market where our investors are based in. So now we assume that both Alice and Bob are based in the US, so the relevant benchmark for them would be S&P 500 index, which is a benchmark comprising 500 largest US publicly listed companies. If you were from the UK, you would pick something like FTSE 250 or FTSE 350. If you were from Germany, you would pick DAX, and so on and so forth. So depending on where are you from and what market are you targeting, you generally consider your benchmark the broadest available stock index that represents your country. When you are dealing with global investments, you can take something like S&P Global 1200 index that expands the American 500 by including 700 international companies into the mix. Or you could take something like MSCI country-specific or global indices. In our case, it's S&P 500, which will do a decent job in our case. What you also need to consider, though, is the risk-free investment alternative. Both Alice and Bob did expose their capital, their savings, to some levels of risk, albeit of varying magnitudes. However, what is generally assumed in portfolio valuation and in finance or investment management in general is that there exists a risk-free investment alternative. Well, what it is? Most commonly, we consider government bonds of established countries, such as the US or the UK, as virtually default risk-free, because governments of developed economies have virtually no chance of defaulting on their debt, so default risk is absent from investing into government bonds. And that's why yields on those sovereign bonds are generally very low, and they represent how much you can make per year if you allocate your capital and take on absolutely no or very, very low, minuscule, negligible risks. So to do that, I've also extracted the data on US 10-year government bond yield. So the yield is basically yield to maturity. So how much return per year would you make if you invest into US 10-year government bonds at a particular point in time? So quite counterintuitively, the risk-free rate for the US and for any other country will change month to month, but it doesn't mean that it is not risk-free, because it's yield to maturity. If you have invested all of your capital into US government bonds at the end of 2007, then it means that you will definitely, well, if the United States would not default, you would definitely have 4.02% annual return. And the fact that it's just being constantly traded on the market makes it such that the risk rate changes. However, we should not discard the fact that the investment is risk-free just by the fact that the yield to maturity changes. So obviously, as we investigate our performance on a monthly frequency, we need to convert those annual yields into monthly yields. To do that, we need to basically adjust them to monthly frequency. To do so, we need to apply our geometric average formula. So 1 plus the yield, and we need to convert it into percentage, so divided by 100, to the power of 1 over 12, as there are 12 months in a year, minus 1. And now we can bottom right click it all the way down and see how the monthly risk-free rate changed throughout the years. Now for monthly returns, we just apply the usual formula. Your portfolio value at the end of next month divided by the portfolio value at the end of last month minus 1. And we can drag it around, bottom right click it all the way down, and get our returns for all three series, for Alice's portfolio, for Bob's portfolio, and for our benchmark, which is S&P 500 in this case. Now we also need to compute excess returns, and the concept of excess return is very simple and intuitive. As an investor, you are taking risk when allocating your capital into anything except government bonds. Then you need to know how much extra return are you getting at every single month compared to a risk-free alternative. So to understand how much you are getting by taking the level of risk your portfolio is exposed to, you just need to subtract the risk-free rate from your raw return. So for all three cases, we just subtract the monthly risk-free rate, and we need to lock the column here, as the risk-free rate is the same for all portfolios but changes with time. And then drag it to the right, and then bottom right click it all the way down. Now we can finally start computing our risk-adjusted return measures. So first, most of the time, risk-adjusted return measures will be reported on an annualized basis. So to comply with this convention, let's just calculate annualized returns and annualized measures of risk. So for annualized return, what we need to do is we need to calculate the geometric mean. So product 1 plus area of returns. And then if we were to have monthly returns, then we will just raise it to the power of 1 divided by 144, because there are 144 months in our sample, which is 12 years. But in our case, we need to convert it to annual frequency, not monthly frequency. So we need to raise it to the power of 12 divided by 144, or to put it more simply, just 1 over 12. As there are 12 years in our sample, and we want to know the annualized return. And then minus 1, and enforce this formula using Shift, Control, Enter. Now we can drag it for all three of our portfolios and see that indeed, in terms of annualized return, Alice has made more than twice as much as Bob per year, and Alice even slightly outperformed S&P 500. But was this high return justifiable in terms of additional risk that Alice has taken in comparison to Bob's portfolio, in comparison to the benchmark S&P 500, or even in comparison to the risk-free rate? Let's find out. To calculate our first risk-adjusted return measure, and perhaps the simplest, the Sharpe ratio, we need to calculate our most simple and most famous risk measure, which is the standard deviation of returns, the volatility of returns. Well, just calculate the sample standard deviation of our returns, and as we want to report it on an annualized basis, just multiply it by the square root of 12, as there are 12 months in a year. So dragging it around, we see that indeed the risk-return relationship is there, and for obtaining a higher return, you generally need to take on more risk. Alice's risk is very high, and higher than the risk of the broad stock market, S&P 500, and much, much higher than Bob's risk, which stands at 3.3% per annum, which is typical volatility for diversified bond portfolios. And finally, to calculate the Sharpe ratio and also all other ratios down the line, we also need to know the risk-free rate that some other hypothetical investor might have invested their capital at the start of the trading period that coincides with Alice's and Bob's. So at the very start of our period, we could have invested all of our capital risk-free at 4.02% per annum. So our risk-free rate for all three cases, that's a hypothetical investor that just allocates their capital to US government bonds, is just the US 10-year government bond yield divided by 100, because we want it in percentage again. So someone who would have done that would get 4.02% per annum. So somewhat lower than what Bob made, a lot lower than Alice has made, and still lower than what the market delivered. So for the calculation of the Sharpe ratio, we need to again remember the logic. How much does the risk taken pay off? how much extra return does your portfolio deliver per unit of taken risk. This is the logic of almost all risk-adjusted performance measures that you will ever encounter. In case of the Sharpe ratio, we need to divide the excess return per annum, which is annualized raw return, minus the annual risk-free rate. So that's how much better in terms of return we are in comparison to the risk-free rate, and then divided by the amount of risk we have taken, divided by our annualized risk. And this is the Sharpe ratio, return minus the risk-free rate in the numerator, divided by annual standard deviation in the denominator. Obviously, you could calculate Sharpe ratios for other frequencies as well. You can do monthly, weekly, even daily Sharpe ratios. No one forbids that. But make sure when you compare different investment alternatives that you calculate the Sharpe ratio in terms of the same frequency, in terms of the same periodicity for all of them, so that your figures are comparable. Having computed the Sharpe ratios for all three investment alternatives, we can see that even on risk-adjusted terms, Alice did outperform Bob, and by a large margin, because her Sharpe ratio is more than twice as high as Bob's. And this logic is the same for all risk-adjusted performance measurement techniques. The higher, the better, because the higher is the measurement, the more return, the more extra return in comparison to the risk-free rate you are getting per unit of risk taken. So Alice has enjoyed a higher excess return per unit of taken risk in terms of standard deviation or volatility than Bob. But the market, it turns out, or an exchange traded fund that tracks S&P 500 would be a slightly better option for someone who wishes to invest their money in 2007, turns out, because the Sharpe ratio of S&P 500 is higher than the Sharpe ratio that Alice's portfolio delivered. And in that case, we can see that Alice outperformed Bob, but underperformed the market in terms of our benchmark S&P 500. Then, to calculate the Treynor ratio, we need to consider another risk measure. Remember, in risk-adjusted performance techniques, you always divide excess return, so return over the risk-free rate, by some measure of risk. In case of the Treynor measure, the measure of risk is beta, which is a measure of variability of the return with respect to the market or to the benchmark. By how much does the return of the portfolio change if the return of the market goes up or down by 1%? That's the question that beta provides an answer for. To calculate betas, we need to apply the slope function in Excel and use excess returns to figure out betas. Our y's, so our dependent variables, are always the arrays of portfolio returns, and our x's, so the explanatory variables, are always the corresponding returns of the market or the benchmark, because we always explain betas in terms of the market, whatever our benchmark is. If the benchmark moves up by 1%, the portfolio will go up by beta percent. If the benchmark goes down by 1%, then the portfolio will go down by beta percent. That's the logic of beta. And here we need to lock the columns in terms of the benchmark, because the benchmark is the same for all portfolios in that case. So we enforce the formula, drag it to the right, and see that the beta of Alice's portfolio is 1.08, which is considered higher than the market that has a beta of 1 by definition, because it's always the case that if the market goes up or down by 1%, the market goes up or down by 1%. So as the market has a beta of 1 by definition, then everything with a beta greater than 1 is more risky than the market. And the beta lower than 1 shows that the level of market risk the portfolio is exposed to is less than what the market is exposed to. But obviously beta is not a perfect measure of risk, as it measures just systematic risk. So risk that is attributable to overall market movements and cannot be diversified away. If we consider real-world portfolios that are not fully diversified, then beta is not a perfect measure of risk, and it only captures the systematic risk the portfolio is exposed to and does not capture the idiosyncratic risk. Idiosyncratic risk is a portion of portfolio risk that cannot be explained by market movements, and pretty much all portfolios have exposure to idiosyncratic risk in some degree, as perfect diversification is very hard to obtain, and the degree of idiosyncratic risk can be evidenced by the correlation between the portfolio returns and the market returns. The closer it is to 1, the smaller the degree of idiosyncratic risk exposure is in proportion to total risk exposure. In our case, as this is a diversified fund, in case of Alice's portfolio, we can treat beta as a reliable measure. Nevertheless, it's always useful to check the results for the Sharpe ratio as well. So for the Treynor ratio, the logic is exactly the same, with beta substituting annualized volatility as the relevant risk measure. So Treynor ratio answers the question, how much excess return do you gain per unit of market risk exposure? So what would your excess return be if the beta of your portfolio would be equal to 1? So if you sort of deleverage your portfolio if its beta is higher than 1, or leverage it up to market exposure if beta is lower than 1. And here the shortcomings of the Treynor ratio and beta become evident. If a significant proportion of your portfolio risk is idiosyncratic, i.e. unexplainable by the market, the Treynor ratio would reflect the portfolio risk-adjusted performance inadequately. It will exaggerate how well your portfolio performs. And here we will see just that. If we divide our annualized excess return, again, nothing changed from the past example, and divide it by beta instead of annualized volatility, we'll see that the highest Treynor ratio so far belongs to Bob's portfolio, which has a very small beta of 0.04. But is the portfolio risk of Bob as small as shown by beta? Of course not. If the beta is true, then the total risk of Bob's portfolio is 25 times lower than the risk of the market. Well, here we see that it's approximately 5 times less than the risk of the market. What happened here? Well, obviously, Bob is exposed to the bond market instead of the stock market. So this beta does not capture the total risk that Bob is exposed to accurately. And that's why their Treynor ratio is much higher than to others. Also, what is quite interesting to note is that Alice's Treynor ratio is somewhat higher than the market's Treynor ratio, evidencing the fact that if you adjust for systematic risk only instead of total risk, encompassing idiosyncratic risk as well, then Alice's portfolio, so global stock market, does slightly outperform the US stock market. But as you adjust for idiosyncratic risk too, which we did in case of Sharpe ratio, then the relationship flips and the US stock market does outperform Alice's portfolio, which is Artisan Global Opportunities Index Fund. And the final measure that we will talk about today is Jensen's Alpha, or as it is commonly known, simply Alpha. A lot of funds or investment companies have Alpha in their name because Alpha is what they're looking for, the ultimate risk-adjusted return. To calculate Alpha, you need to subtract the return that is expected of your portfolio given its market risk exposure from the actual excess return that your portfolio delivered. So it's very simple. We just subtract some measure of risk from the actual excess return, then dividing by it. So we take our annualized return, subtract the annual risk-free rate, and then we subtract the return that would have been expected of us if we had a beta of 1.08. So we multiply our beta by the return of the market, and we log that because the return of the market remains the same for all portfolios, minus the annual risk-free rate. So the logic is very simple. By how much did you outperform the market while adjusted for your beta exposure, to exposure to market risk? We see that the alpha of Alice's portfolio is slightly positive, small but positive, 0.02% per annum, which means that we slightly outperform the market when adjusted for systematic risk alone. Because still, as you can see from the formula, similar to the Treynor ratio, we only adjust for the market beta, for systematic risk. We don't take into account idiosyncratic risk of the portfolio. And dragging it around, we see that the alpha of the market is always 0 by definition, because the market can't outperform or underperform itself. And the alpha of Bob's portfolio is positive and even higher than the alpha of Alice's portfolio, as again we have already discussed, the beta is so small for reasons other than the risk being that small. It's because the bond market is not fully captured by stock market movement. And that's all there is for Sharpe ratio, Treynor ratio, and Jensen's Alpha. If you would like to see more and more advanced risk-adjusted return measures in future videos, please leave a like under this video and leave your suggestions in the comments below. Thank you very much, stay tuned, and don't forget to subscribe to our channel.